and welcome. You have tuned into Midcap Masala right here on ET Now. I'm Shrishti Sharma and with me is Snehi Shah. And over the course of next half an hour, we'll tell you what's really happening in the markets. And let's start with the movement on the index front because, yes, of course, we have seen Nifty breaking below that 24,000 mark on an intraday level and it's up that 24,000 mark, trading close to that 24,960 odd levels. When it comes to Nifty Bank, more than 300 points of cuts is what we are getting to see. And yes, of course, the IT pack is the biggest loser for the markets right now. And it's not just the large cap IT names that are down in trade today, but the mid end of the market within the IT space is also very much hammered in today's trading session. But let's move on and let's put the spotlight on Tata Capital. Then we have Mr. Rajeev Sabarwal, who is the MD and CEO of Tata Capital, joining us on the show. Hi, very good morning and thank you so much for your time. And first up, let's talk about your credit cost. We see that your credit cost has declined sharply in Q4. How do you see the sustainability of this going forward?
So if you look at, what we've been doing over the years is to build a culture of risk management in the organization and getting the message through that risk comes first. We've always been very focused on credit quality. We've used data extensively in making decisions, used scorecards a lot. So all of this has helped us over a period of time to improve credit quality. We saw especially credit quality improving on the retail unsecured side post Q2. Q2 was better than Q1, Q3 was better than Q2, and Q4 was better than Q3. So we believe that we've built a portfolio which is very resilient, and that along with our focus on doing collections based on a lot of data is also helping us. Of late, we're using GenAI extensively to make calls and give propositions to customers.
Okay, and Mr. Sabarwal, also help us understand how your other metrics are going to be shaping up. Can we assume that FY27 is going to be better here, and can we see improvement from Q1 onwards?
So if you look at a few things which have worked very well for us, one is the growth. Growth has been extremely strong. If I exclude the motor finance business which got acquired, our growth was about 28%. Credit cost, as you saw, has come down and clearly stands out as one of the best in the industry. The other is operating efficiency is also improving. Our cost to income has come down by over 300 basis points compared to last year. As we look into the future, I am pretty optimistic on growth. Our guidance for FY28 is this, that we will grow at about 23 to 25%, and we are working towards the same. We believe the potential exists for us to continue on our growth journey. We also expect further improvement in cost efficiency to come in with more use of data technology and now GenAI. A lot of projects are happening in that space. We also expect the quality of the book which we have created to sustain over a period of time. The other thing which we are trying to do is improve the mix of high margin products in our total business, which will lead to margin improvement also. So it's a combination of this, which we believe will help us to further improve our ROAs.
All right, along with that, Mr. Sabarwal, how are you reading the risk of West Asia crisis? What are the concerns that you foresee with respect to the geopolitical situation right now?
So if you look at what's been happening, we've seen the government pretty focused on ensuring that the impact is minimized. We've not seen any impact on fuel prices. The other thing I think every corporate is conscious of and every MSME is conscious of is that they need to ensure that the supply chains keep running. A lot of them have carried raw materials for 3 months or so, which is ensuring that their productions are not disturbed. We are also hearing from them that they are getting raw material, maybe at higher prices, but they are able to access, which is ensuring that the production goes on. Consequent to this, when we reviewed our portfolio, we did not see any impact as of now of the West Asia crisis. However, this is something which we continue to watch, and we will watch this two segments very closely, the MSME and the commercial vehicle segment.
Right, okay. And Mr. Sabarwal, there's been a noticeable uptick in your corporate lending. Are you consciously taking more wholesale exposure at this point in the cycle?
So if you look at our book, our total book, retail plus SME forms about 86% of the total book. So we are largely retail and SME, with the largest segment for us being the housing finance business. In fact, the housing finance business now forms about 30% of our total book. However, we do look at opportunities where we can get lending on the corporate side. So we try to maintain a mix. In fact, the way we are looking at the next year, we expect housing and retail to grow at a faster pace, and you will see that proportion growing in the coming year.
All right, but what gives you confidence that motor and unsecured book will grow well over FY27? Now, what sort of an industry-wide improvement are you expecting?
So if you look at motor finance business, we acquired this business in May of last year. The business, we could break even in the business in Q3 of FY26, and in Q4, we made money in that business. We do expect that this to keep improving with every quarter. As far as retail unsecured is concerned, we have always said that the steps which we took over the last 2 years will help us bring down credit costs, and that's played out exactly the same way. Q2 credit costs were lower than Q1, Q3 was lower than Q2, and Q4 was lower than Q3. And looking at all early trends, we expect this to continue. We've embedded a lot of scoring. We've embedded a lot of now unstructured data, which we use also along with structured data to make those decisions. And those credit models are continuing to hold very well. So we are pretty optimistic that the credit costs, both on the motor finance business as well as on retail unsecured, will be sustained at lower levels.
Okay, well, that sounds really optimistic, Mr. Sabarwal. So I'm just trying to get a better sense. Concluding everything that you've said so far, can we positively conclude that all your engines will fire heading into FY27? And if you could help us understand any risks of that not translating, any potential headwinds that you're noticing at the moment?
So if you look at, growth, we're fairly optimistic. As far as cost to average assets or cost to income is concerned, we've embedded a lot of technology and are increasingly using more GenAI in our operations, which will help us bring down our cost of doing business. Credit costs, we are looking at all early indicators, starting from the bounce rates to looking at our early stage collections. All of them are showing a positive trend. So I don't foresee any problem at this point of time. But more importantly, we have a very agile and a nimble team. If we detect any problem, we are quick to take action on the same. That's what we have done in the past, and that is what we will continue to do in the future. We are extremely data-driven, and we have a team which knows that risk comes first before business.
All right, and along with that, Mr. Sabarwal, margins will move up as a result. And by how much? What is your sense on margins?
So as far as the coming years are concerned, we expect margins to improve. We expect cost to income to come down, and we expect low credit costs to sustain. That will help us to further improve our return on assets. It's difficult to quantify actually, but you will see that movement happening because the proportion of high margin products for us in our overall mix is growing.
Okay, and lastly, Mr. Sabarwal, levers for return on asset expansion, anything at play right now? Will it only be credit costs? Is it going to be a mix of OPEX, credit costs, margins? Any outlook that you can give us?
So it will come from all three segments. NIM plus fee will grow, our operating efficiency will improve, and our credit costs will come down. We have guided for a credit cost of sub 1%, our cost to income of 33 to 34%, and further margin improvement. So all three of them will play out in the future.
Okay, on that note, Mr. Sabarwal, thank you so much for your time today. It's been good chatting with you and good luck for the quarters to come. Viewers, with that, it's time to slip into a very short break on this edition of Midcap Masala. When we return, we'll have more corporate conversations lined up basis quarter 4 earnings reaction. So you stay tuned and we'll be right back.